Welcome to The Deep Dive, your shortcut to being well-informed on the market's most impactful earnings calls. Today, we're digging into SS&C Technologies Q2 2025 results. And it's more than just numbers. We're looking at how a financial infrastructure company is really pushing hard into AI, even blockchain. It's quite a story brewing there. We'll unpack the performance, their big strategic plays, the outlook, basically give you a sharp, actionable view of where SS&C might be headed.
Yeah, it was quite a quarter for them. They really hit some significant milestones. Seems like they're blending their traditional strengths in financial services with some pretty cutting-edge tech effectively.
Okay, so let's jump right into those Q2 results then, because, the headline numbers definitely stood out. SS&C reported record-adjusted revenue, get this $1.5378 billion, that's up 5.9%. And the bottom line, adjusted EPS grew almost 10%, 9.8% to $1.0145. That kind of tandem growth, top and bottom line, isn't something you see every day.
No, it isn't. And what's really telling, I think, is the profitability picture. They hit a record-adjusted consolidated EBITDA, just over $600 million. $600.4 million to be exact, up 7.4%. And that resulted in a really strong margin, 39%, which importantly is a 50 basis point expansion.
50 basis points. That might not sound huge to everyone, but in this environment.
Exactly. It signals really tight operational control, right? Because especially when so many firms are battling rising costs, it suggests they're not just growing, they're getting more efficient as they grow, growing smarter.
And it wasn't just acquisitions fueling this, was it? The core business seems solid too. Adjusted organic revenue growth was, 3.5%, which for a company their size, that's pretty healthy, shows the underlying engine is humming.
Absolutely. And look at the cash flow. First half of the year, cash from operations climbed 14% year over year, $645.1 million. That's serious money being generated.
Yeah, serious cash. And they're putting it to work, right, with the buybacks.
Oh, yeah. That robust cash flow directly fuels their capital allocation. In Q2 alone, they bought back 3.4 million shares, spent about $269 million doing it. And maybe more importantly, they just boosted their total share repurchase authorization up to $1.5 billion.
$1.5 billion. Okay, that's not just routine housekeeping. That's a big statement of confidence, wouldn't you say?
It really is. It signals management believes the stock is undervalued and they're committed to returning capital to shareholders. Often a very positive sign for investors.
And the balance sheet, how's that looking?
Still looks quite strong.
Yeah.
Net leverage came in at 2.72 times. They've got about $480 million in cash against roughly $6.9 billion in gross debt. For a company like SSNC, which often uses M&A for growth, that kind of leverage ratio gives them a lot of flexibility.
Right, plenty of dry powder for the next deal without getting overstretched.
Precisely. So, the financials look solid. Maybe we should dive a bit deeper into the operations. What's actually driving these numbers?
Okay, let's do that. Unpack the growth engines. You mentioned organic growth. A big piece of that was GlobeOp, right? Their fund administration arm.
Yes. GlobeOp had a really strong quarter. Think of it as the essential back office plumbing for investment funds. It saw 7.3% organic growth. And that was really driven by two key areas.
Which were? Double-digit
growth in private markets. So private equity, venture capital, that sort of thing. And also retail alternatives. That segment actually grew 20%.
20% in retail alts. Wow. That's huge. Those are the complex, less liquid investments becoming more mainstream, right?
Exactly. Things like complex credit funds, hybrid funds, even sophisticated family office needs. They see a lot of runway there because of that complexity.
And it wasn't just GlobeOp carrying the load, though.
No, definitely not. GIS, their Global Investor and Distribution Solutions unit, kept landing significant client wins. Still a core strength. And WIT, the Wealth and Investment Technology segment, also chipped in positively. Shows the breadth of this service offering.
What about the health segment? That was flat organically, wasn't it?
It was, yeah. But they specifically called out the seasonality there. Apparently, a lot of deals in health close late in the year, like Q4, for go-lives on January 1st. So it can look a bit lumpy quarter to quarter, but they see it as a major long-term opportunity.
Okay, so that lumpiness exists. How do they smooth it out for consistent overall performance? Is it just diversification?
Diversification helps, but a huge factor is client retention. They highlighted a stable rate of 97%.
97%. That's incredibly sticky revenue.
It really is. It shows clients are generally happy and locked in. That provides a very stable base.
Okay, now, the part that really jumped out at me, the AI angle. They seem to be getting serious about it.
Oh, absolutely. This isn't just talk. They are actively deploying it.
Yeah.
They're investing consistently in their AI strategy. And a big part of that is using Glue Prism.
Their RPA platform, right? Robotic process automation.
Exactly. Integrating Glue Prism across different business units, automating workflows, and crucially, deploying new AI agents internally.
And they actually sold one, an AI agent.
Yes. Their first external sale to a Midwest insurance conglomerate. And the results they're talking about are, well, they're pretty impressive.
Like what?
Get this. The agent reduces manual effort by up to 80%. 80. It speeds up processing threefold and achieves over 99% accuracy handling complex credit agreements.
Okay, 80% less manual work.
Right.
That's transformative, not just tweaking things. That's replacing entire workflows.
Totally. And they see this as just the beginning, right? A proof point for their massive client base. What is it? 22,000 clients. The potential is huge.
And they're using it themselves, too, eating their own cooking.
Definitely. They mentioned Blue Prism has already deployed several thousand digital workers internally. And the impact, they described it as a couple $100 million in cost savings or avoided spending. That's a powerful internal validation.
Wow. Okay, so AI is clearly a focus. What about other software? Anything new gaining traction?
Yeah, they highlighted a couple. Genesis, their platform for asset managers and trusts, seems to be doing well. Multiple implementations are underway. They specifically mentioned a recent go live at a pretty big bank trust, over $75 billion AUM, where they actually replaced a competitor. That's always a good sign.
Displacing an incumbent. Nice.
Right. And Singularity, another platform, has been landing large insurance clients. They're continuously adding coverage to bank loans, commercial mortgages, income monitoring. So broad-based investment across the portfolio.
So this diversification and tech investment, it seems to be helping them weather storms too, like macroeconomic headwinds.
It appears so. They acknowledge things like the slowdown in global deal volume, which impacted their Interlinks platform in Q2. But they also noted early signs of a pickup in the second half. And interestingly, they mentioned their new AI-powered Deal Center platform is actually helping increase win rates even in a tougher market, using tech to fight back.
That's smart. And connects to their spending, right? The CapEx has been running a bit higher than usual.
Yeah, over 4% of revenue versus historically more like 2-3%. But management framed it very clearly as investment in growth, not just keeping the lights on. They cited ongoing R&D for new products, new geographies like Australia, enhancing existing suites like GlobeOp and Genesis. It's future-focused spending.
Okay, makes sense. So that covers operations. Let's shift gears to the strategic vision and the outlook. Big news on the M&A front, right?
Yeah.
Callison.
Huge news. A definitive agreement to acquire Callison. Expected to close in Q4. This looks like a really significant strategic move for them.
Why is significant? What does Callison bring?
Several things. Attractive new geographies, for one, plus new capabilities in really hot areas, ETFs, digital assets, money market products. And importantly, Callison has about 4,500 clients, opening up huge cross-selling opportunities for SS&C.
And Callison's growth profile.
Historically, Callison's been growing faster than SS&C, over 10%, maybe closer to 15%, and SS&C thinks they can actually accelerate that.
Accelerate 15% growth. Ambitious.
It is, but it fits their model. The deal is expected to add to revenue growth, EBITDA margin, and EPS within just 12 months. It ticks all the boxes for their disciplined acquisition strategy. High quality, strategic fit, financially accretive quickly.
And the tech side of Callison. Anything interesting there?
Very interesting, actually. They have something called the Funds Network, does back office stuff like post-trade processing, reconciliation across like 57 countries with minimal manual work. But the really intriguing part is their BMI platform. It's blockchain native.
Blockchain native. Okay, that's definitely forward-looking. What's the plan there?
SS&C is openly talking about exploring routing. Significant transaction flows through it. The potential. Big cost savings compared to using older traditional messaging systems like Swift. It's a direct play on future financial infrastructure.
Fascinating. Okay, so Callison is a big piece. What about the forward guidance? Did they update that?
They did. And they raised it for the full year, which is always a positive signal. For Q3 specifically, they're projecting revenue between $1.525 billion and $1.565 billion. That implies about 4.5% organic growth at the midpoint. And adjusted diluted EPS expected between $1.44 and $1.50. Pretty solid continuation.
And the full year raise.
Yeah, they bumped up the full year revenue guidance by $15 million at the midpoint, now expecting between $6.143 billion and $6.243 billion. Organic growth still pegged at that 4.5%. And adjusted EPS guidance also got a boost, up 10 cents at the midpoint. now $5.82 to $6.06. Plus, strong cash flow expected to continue, projected between roughly $1.48 billion and $1.56 billion for the year.
Raising guidance mid-year like that, it definitely shouts confidence, right? In their execution, their market.
Absolutely. It suggests the momentum they saw in Q2 is expected to carry through.
Now, you mentioned M&A flexibility earlier. Did they talk about leverage philosophy? How much debt are they comfortable taking on for deals?
They did touch on that. Management basically said they're comfortable operating the business at mid-4 times net leverage.
Yeah. Mid-4s. Given their current leverage is under 3, that implies quite a bit of headroom.
It really does. It suggests they could potentially stomach, maybe even a $5 billion acquisition if the right opportunity came along. They justified it by pointing to how sticky their client base is and their position in these sweet spots of financial services areas with high switching costs.
Okay, big M&A potential then. One last detail, Batala, their class action services business. Any update there?
Yeah, just a quick note. It wasn't consolidated in Q2 financials. It's growing historically at low double digits, but it's also very seasonal and lumpy. Apparently, over half the revenue tends to hit in the second half of the year as courts clear their dockets. They expect that same kind of H2 acceleration this year and feel they're getting a better handle on predicting its revenue patterns.
Right, so becoming a more predictable contributor over time. Okay, so let's pull this all together. What are the key takeaways for you, our listener?
Well, I think what really stands out is SS&C's consistency, delivering strong financials quarter after quarter, while also making these really quite significant strategic bets on the future. The record EBITDA, the strong cash flow, that's the solid foundation.
And connecting that to the bigger picture, these investments in AI, the Callison deal, bringing in blockchain capabilities, this isn't just tinkering, is it? It feels more like a fundamental commitment to boosting efficiency and grabbing territory in high-growth areas like digital assets, ETFs. It suggests a real long-term strategy to, widen their competitive moat, maybe even disrupt some older ways of doing things.
Which leads to the big question, right? How does this aggressive tech adoption and strategic M&A position SS&C versus more traditional players, especially over the next cycle? And you have to remember that diversified, sticky revenue base gives them a cushion, a degree of resilience, even if the macro picture gets choppy.
Okay, so solid performance, strategic investments, future focus. Now let's switch gears slightly. Time for our not financial advice segment. Oh. We put on our imaginary hedge fund analyst hats and brainstorm some, let's call them outrageous, but plausible thought experiments based purely on this call. Remember, just ideas, not recommendations.
All right, let's play. Pitch number 1. Long SS&C, short legacy financial infrastructure providers.
Okay, explain the rationale there.
Well, it's pretty straightforward, building on what we just discussed. Yeah. SS&C isn't just talking AI, they're doing it. They're showing real results. 80% less manual work, 3x speed increases. That's massive efficiency gain. Then you add Callison, bringing blockchain native tech, and they're openly considering routing flows away from older, costly systems.
So the bet is basically SS&C innovates faster.
Yeah, the bet is that SS&C, through its own R&D and smart acquisitions like Callison, will significantly outcompete and maybe even disrupt those older financial infrastructure players who are perhaps slower to adapt to these big tech shifts.
Okay, interesting. Plausible, if perhaps outrageous. What's the second idea?
Pitch 2 builds on a similar theme. Long SS&C short. A company heavily reliant on manual back office processes.
So targeting a specific type of company.
Exactly. SS&C's success with Glue Prism, that first AI agent sale, it demonstrates a clear path to boosting operating leverage by swapping manual work for AI. This suggests that other firms in financial services, especially those still bogged down by complex manual back office work without much automation, they could be at a serious disadvantage.
An existential threat, almost.
Could be. So the trade idea is a bet on this technology arbitrage. Long SS&C betting on their efficiency gains, and short, a less advanced competitor, betting that SS&C will grab market share from them due to superior operations.
All right, 2 interesting, thought-provoking scenarios there. Again, purely hypothetical, not financial advice.
Definitely not advice. Okay, so wrapping up on SS&C's Q2.
Yeah, in summary, a really robust quarter. Record results, sure, but also these key strategic investments in AI, blockchain via Callison.
And a disciplined approach to putting their capital to work, both through buybacks and M&A.
The Callison deal really signals that continued push for growth, expanding into critical areas like digital assets, reinforces that long-term vision.
Which leaves us with that final thought. As SS&C keeps embedding AI and these newer technologies deeper into financial services, how does that change the game? What does it mean for competition, for efficiency, for how financial firms scale in the future? Something to keep an eye on.
Definitely. As always, this deep dive is just for informational purposes. It is absolutely not financial advice. We always encourage you to do your own thorough research. Thanks for tuning in.